That is not a warning. That is not a threat. It is simply the reality of what changed in 2026, and the reason that thousands of self-employed workers across the United Kingdom are going to receive letters, face penalties, or find themselves with backdated tax bills this year while genuinely believing they did nothing wrong. The rules did not change overnight. They changed gradually over several years in ways that nobody wrote to explain to the people they affect most. And the result is a very large number of self-employed people, sole traders, freelancers, gig workers, landlords, people running small businesses from their kitchen table, who are operating right now under a completely outdated understanding of what HMRC can see, what HMRC expects, and what happens when the two do not match. I want to go through this properly today, not in vague terms, not as a general reminder to keep your receipts. I want to show you exactly what changed, exactly who it catches, exactly what the consequences look like, and the specific steps that protect you before HMRC makes contact, rather than after. Because here is the thing about after. After HMRC makes contact, the conversation is different. Before HMRC makes contact, you are in control. If you are not subscribed to this channel, please do that now. What I cover here is not available in a DWP letter, an HMRC press release, or a general news story. It is the detail underneath those announcements, the part that tells you what it actually means for your specific situation. Hit subscribe and turn on the bell. Let us get into it. The first thing you need to understand is the scale of what HMRC can now see, and it is considerably wider than most people realize. Since the 1st of January 2024, every major digital platform operating in the United Kingdom has been legally required to collect identity and earnings information from sellers and earners and report it directly to HMRC annually. That includes eBay, Etsy, Vinted,
Airbnb, Deliveroo, Uber, Fiverr, Amazon. Any platform through which you sell goods, deliver services, rent property, or perform gig work. The first batch of that data, covering calendar year 2024, was reported to HMRC by the 31st of January 2025. HMRC has now matched it against self-assessment returns filed for the same period. In spring and summer of 2025, HMRC began sending what are internally called one-to-many letters, nudge letters issued to tens of thousands of sellers who appeared in platform data but had not filed a tax return. If you received one of those letters and did not act on it, the follow-up is not a gentle reminder. It is an investigation. And an investigation that HMRC initiates because they found you, rather than one that begins because you came forward voluntarily, carries significantly higher penalties. The data for calendar year 2025 was reported to HMRC at the end of January 2026. Matching against 2025 to 2026 tax returns is happening now. If you earned money through any of those platforms last year and did not declare it, HMRC may already have information about your income that you have not told them about. The question is no longer whether they will find out. The question is what state your affairs are in when they do. For self-employed workers and sole traders whose income is entirely or mainly from platforms and their own clients, the legal obligation is straightforward. If your total gross income from self-employment in any tax year exceeds £1,000, you must register for self-assessment and file an annual tax return. Gross income means the total amount received before deducting any expenses, not profit, not what is left after costs, the total coming in. The £1,000 trading allowance means the first 1,000 of that gross income is tax-free, but it does not mean you can avoid registering once you cross it. Registration is the legal requirement. The filing is what follows from registration, and the tax owed is calculated on your
profit after legitimate business expenses, not on your total turnover. The deadline to register for self-assessment if you were newly self-employed in the 2025 to 2026 tax year is the 5th of October 2026. That date is 11 weeks away. If you started earning self-employment income after April 2025 and have not yet registered, that is your deadline. Miss it, and HMRC treats the failure to register as a compliance failure, with potential penalties on top of the tax eventually owed. If you have been self-employed for longer and have never registered, because your earnings felt too small, because you assumed cash work did not count, because nobody told you the threshold was as low as it is, voluntary disclosure is the single most important thing you can do right now. HMRC has a disclosure facility specifically for this situation. Coming forward voluntarily before HMRC identifies you through platform data or a bank data match results in significantly lower penalties than being found. The difference between a voluntary disclosure and a compliance check HMRC initiates themselves can represent thousands of pounds in penalty reduction on the same underlying tax debt. Now I want to talk about the change that came into force in April 2026, because this is the one that is creating the most confusion among self-employed workers right now, and the confusion is completely understandable because the change is genuinely significant. It is called Making Tax Digital for income tax, and for a specific group of self-employed people and landlords, it replaced the annual self-assessment tax return entirely from the 6th of April 2026. Here is who it currently applies to. If your combined gross qualifying income from self-employment and property in the 2024 to 2025 tax year exceeded £50,000, Making Tax Digital for income tax is now mandatory for you. That is gross income, not profit, not take-home, the total coming in from self-employment and property before any deductions.
You are a sole trader who billed £60,000 last year and spent £25,000 on expenses. It is the £60,000 that counts for the threshold, not the $35,000 profit. What Making Tax Digital requires from you is no longer one annual return filed in January. It requires 4 quarterly digital updates filed every 3 months using HMRC-compatible software, plus an end-of-period statement and a final declaration at the end of the tax year. The quarterly filing deadlines for 2026 to 2027 are the 7th of August 2026, the 7th of November 2026, the 7th of February 2027, and the 7th of May 2027, followed by the final declaration by the 31st of January 2028. The penalty framework for Making Tax Digital is a points-based system, different from the old flat fine regime. Each missed quarterly update earns 1 penalty point. When points accumulate to the threshold, a £200 financial penalty is charged. Further missed filings then attract additional £200 penalties each. Points remain on your tax record for 2 years before expiring. Importantly, HMRC has confirmed there are no penalties for missing quarterly updates specifically during the 2026 to 2027 tax year, the first year of mandation, as part of a grace period for people adjusting to the new system. But that grace period applies only to quarterly updates. It does not apply to the final declaration. Missing the 31st of January 2028 final declaration deadline carries immediate financial penalties under the new regime. The threshold for Making Tax Digital drops to £30,000 from April 2027, bringing a significantly larger number of self-employed workers and landlords into scope, and it drops again to £20,000 from April 2028, covering the vast majority of anyone with meaningful self-employment income. If you are currently just below the £50,000 threshold, the window before this system reaches you is shorter than it might feel. If you are in scope and have not yet set up compatible software, that is the immediate priority. HMRC does not accept quarterly updates through its own website. The updates must be submitted through HMRC-recognized software. Accounting packages such as QuickBooks, Xero, Free Agent, and several others are approved. The list of compatible software is available at gov.uk, and that is the correct starting point. The software handles the quarterly submission format. Your job is to keep digital records and make sure the numbers going in are accurate. If you believe you should be in scope but have not received any communication from HMRC about Making Tax Digital, do not interpret the silence as exemption. HMRC is writing to affected taxpayers, but the obligation does not begin only when the letter arrives. It began for qualifying taxpayers on the 6th of April 2026. Check your 2024 to 2025 gross income figures. If they exceed £50,000 from self-employment and property combined, you are in scope now. Let me stop here for a moment. If this is landing differently from what you expected when you clicked on this video, if this is more complicated, more immediate, or more specific to your situation than you realized, drop a comment below. Tell me which part surprised you most. I want to know where the gaps are, because understanding where people are getting caught means I can cover those areas first. Back to the main picture. The third area I want to cover involves the self-employed workers who are not running significant businesses, but who are earning income on the side. The plumber who takes cash jobs at weekends, the person running a small Etsy shop, the Deliveroo driver picking up shifts around employment, the cleaner or gardener who works for a handful of private households. This group is now significantly more visible to HMRC than it was even 2 years ago. Platform data reporting catches the gig workers and the online sellers. Bank data matching catches the cash workers. HMRC uses information provided by banks under existing legal powers to identify people with income patterns inconsistent with their declared earnings or absence of a tax return. And the personal allowance position means more self-employed people are in a taxable position on smaller incomes than they may realize. The personal allowance for 2026 to 2027 is £12,570. A sole trader earning £15,000 gross with £3,000 in legitimate expenses has taxable profit of £12,000. Below the income tax threshold, but still liable for Class 4 national insurance on profits above £12,570 once that level is crossed. And Class 2 national insurance contributions are now collected through self-assessment for self-employed people with profits above the small profits threshold of £6,725. National insurance is not income tax. People sometimes assume that because they fall under the income tax personal allowance, they have no liability. That is not always correct. The NI calculation sits alongside the income tax calculation and applies separately. If you are self-employed and have not been filing a tax return because your income felt too low to matter, the correct check is to run the full calculation. Gross income minus legitimate business expenses gives you profit. Profit above £6,725 generates a national insurance liability. Profit above £12,570 generates both income tax and national insurance. Do not assume one threshold means zero obligation across the board. Here is what to do and in what order. If you are self-employed and not registered for self-assessment, go to gov.uk right now and search for Register for Self-Assessment. If your gross self-employment income in 2025 to 2026 exceeded £1,000, registration is your legal obligation. The deadline for notifying HMRC that you need to file a return for 2025 to 2026 is the 5th of October 2026. Do not miss it. If you have undeclared self-employment income from previous years, use HMRC's voluntary disclosure process. Search for HMRC Disclose Unpaid Tax on gov.uk. Coming forward voluntarily results in substantially lower penalties than
waiting to be found. Every month of delay after platform data has already been reported to HMRC makes the voluntary position weaker, not stronger. If your gross income from self-employment and property in 2024 to 2025 exceeded £50,000, you are already in Making Tax Digital for income tax. Get compatible software in place now. The first quarterly deadline is the 7th of August, 2026. The software setup takes time. Start now. If you are on track with your self-assessment filing but have a payment on account due on the 31st of July that you are struggling to pay, contact HMRC's Time to Pay team on 0300 200 3822 before the deadline, not after. A plan agreed before the 31st of July costs less and creates fewer problems than enforcement started after it. And if you have received any letter from HMRC, a nudge letter, a compliance check opening, a simple assessment, or any other formal communication, do not set it aside. Every piece of HMRC correspondence has a response window. Once that window closes, HMRC's next step is less negotiable than the conversation that was possible during it. The landscape for self-employed workers in the United Kingdom changed in April 2026 in ways that are not obvious until you look at them properly. The tax obligations themselves have not fundamentally changed. You report your income, you pay what you owe. What changed is HMRC's ability to see what you have earned before you tell them, and the structure through which they now expect you to report it. That combination, greater visibility and more frequent reporting requirements, means the consequences of falling behind, whether accidentally or otherwise, land faster and harder than they used to. You have been told what the deadlines are. You have been told where the visibility sits. You have been told what voluntary disclosure looks like versus waiting to be found. The next step is yours. If this video has been useful, share it with someone who is self-employed and has not thought about this recently. The person who needs this information most is probably not the one who was already looking for it. Subscribe if you are not already here, because the next layer of this system, the drop to the £30,000 threshold in April 2027, is coming, and there will be a lot to explain before it arrives. I will see you